Refinance or not to refinance? That is your question. In this video, we'll cover 4 concepts that will help you pay the least amount of interest on your home loans by refinancing when rates come down. Concept 1 is the ratchet down concept. Well, if we had total certainty that rates would go from the 7s to the 3s, let's hope, or the 4s, we would only refinance you once to save you money on the closing costs. Unfortunately, no one has a crystal ball. This thing don't work. So we must take what we can get. This often results in a ratchet down approach where we refinance every time rates drop 1%. Over time, you may go from 7 to 6 to 5 to 4 and hopefully 3. Every time you refinance, you get some payment relief. All right, concept 2 is the payback period concept. Within the ratchet down concept, we can refinance you every 1% as long as the loan is efficient, meaning it pays for itself in 18 to 24 months. We calculate the payback period by dividing the closing costs by the savings. Here's an example. Let's say you add $3,000 of closing costs on your loan and you save $150 a month. Well, that makes the payback period 20 months. Well, that totally makes sense. But if you're only going to save $100 a month, well, that's a 30-month payback period, so we'd probably tell you to wait. Concept 3 is the optimal loan amount concept. When you refinance, you must take into consideration the closing costs, the skip payment, and possibly an escrow account refund from your current loan. If you want to get a little cash in hand and have enough equity, you can keep your skip payment and the escrow account refund. But if you're hawkish and you want to minimize the increase in your loan balance, you could temporarily bring monies to the closing table, knowing that your skip payment and escrow account refund will reimburse those funds. Concept 4 is the high rate debt elimination concept. Interest rates on credit cards are super high, variable, and not tax deductible. Conversely, the interest rate on a new first mortgage is much lower, has a fixed rate, and is tax deductible. By retiring credit card debt with a cash out refinance, you can reduce the interest you pay over the lifetime. As a side note, some credit cards take 20 years to pay off. So once you pay off the credit cards, you can use some of the extra cash to make larger payments and reduce the total interest charges on your home loan. Even though this is a great strategy, you don't want to make it a habit of turning your home into an ATM machine. Hey, as a bonus, you may be able to reduce or eliminate your monthly mortgage insurance payments when you refinance. So this is like icing on the cake. Please connect with us to see when you should refinance so you are ready when rates dip. We only need your mortgage statement, both if you have 2 loans. In fact, you can email it to us and we will email you back an analysis with a target interest rate for you.